Welcome to the 15-Minute Financial Feast podcast, bringing you 15-minute segments to help you retire with purpose on time. We're serving up food for thought and bread for the head. Are you hungry to learn? Here are your hosts, Mark Triplett and Troy Westendorf.
During this episode of the 15-Minute Financial Feast podcast, we're listening in on Troy Westendorf and Mark Triplett's Lunch and Learn series, where they covered a wide variety of retirement and tax planning strategies to help you retire with purpose on time.
Hey everyone.
Hi guys.
Mark Triplett here.
Troy Westendorf. Good to have you today.
Welcome to our Lunch and Learn session today. This is our series of different topics. I'm going to keep this to about 15 minutes in length. And each week we're trying to bring some value to those of you who are clients of ours, or maybe those who have been to workshops in the past but haven't taken those steps yet. Welcome to have you with us here and get a little food for thought, a little bread for the head. And this particular week, we're going to be talking about the myth that you have to take on additional market risk if you want to get a higher return. We've actually outlined 3 different ways that you could potentially increase your portfolio rate of return without taking additional market risk, and exactly how to go about doing that. So, Troy, to go ahead and get us started here today, we hear this a lot that, Wall Street firms say that we have to take on additional market risk if we want to get a higher rate of return. And that's kind of been drummed into our head over the years.
Right.
But we know that there is some truth to that risk-reward relationship. If you traditionally, if you take more risk, then you're expecting to get a higher reward.
More reward.
But there are ways that you could potentially increase the overall return on your portfolio without exposing more of your assets than you already have at risk in the market. And one of those 3 ways is, number 1, to avoid losses. Number 2, minimize taxes. And number 3, strive to reduce fees and expenses on your investments. So we're going to cover all of those today. Troy, as we kind of launch into this, Warren Buffett famously said that rule number 1 of investing is don't lose money. Right. And rule number 2 is never forget rule number 1. So kind of share with us, if you would, a little bit, how is it possible to avoid losses on your retirement resources?
Yeah, so there's things out there that can do this just for that purpose of avoiding losses. So there are products where you can avoid losses and maybe on the offset not have as big of returns. So what we do we use products that have that floor of no losses. So you get a 0%. So if you're going to have, let's just say the markets go up 20% a given year, and our product that we're using has a 50% participation rate following the S&P 500. If it goes up 20%, we get half of that. So we would get 10%. If it goes up 10%, we would get half of that. We get 5%. The upside for that is it has a downside protection. So in a year where the markets, let's just say the markets lose 20%, we would not take any losses for that given year. So that is the trade-off is we get 0% on that loss. So let's just say that the next year it rebounds 20%, we would get 10% of that growth. So the trade-off is you're not getting all of the growth, but we're also not accepting any of the market risk.
Right. And when you avoid the losses, you don't have to capture all of the upside potential in that case, exactly. Right? So if you start with a $100,000 and you expose it all to market risk, and the market goes up 25%, and that can happen, right? That's happened before.
Oh, yeah.
So your 100,000 would grow to 125, right?
Yep.
But then the next year, let's say the market drops and it goes down 20%, because the market usually goes down less than it goes up. Over time, market goes up more than it goes down. So in that case, a 20% loss on 125,000 would drop you to 105, right?
Exactly.
Wrong. And it drops you to 100,000. So you're back to where you started.
Exactly.
So in that particular case, you've got a net 5% rate of return, average 2.5 over that period of time, but you actually make no traction, no gain at that point. With a loss avoidance strategy, you may not get all of that upside potential. If the market goes up, maybe if it goes up 25%, you get half. right? So in that case,
Right.
you get credited with 12.5% instead of 25. But on the flip side, when the market drops, you don't lose anything. So 100,000 becomes 112,500. The following year, the market drops 20%. You don't lose any of that. You still have 100,000, 112,500.
Right.
That's
Right.
roughly a 6.25% average return over those 2 years. Now, over time, we believe that the market will do well. And if you have money that you don't need for at least 10 plus years, so 10, 15 years or longer, and you can take managed moderate market risk for a return, that the market will do well over time. But if there are resources that you need sometime in the next 3 to 10 years that have to be there. If you have resources that you need next year, they probably should be in the bank. But if you have money that you need sometime in the next 3 to 10 years, and you really can't weather a downturn in the market that could last 7 years or longer from peak to trough back to break even, then we might use a strategy like this loss avoidance strategy, where we can capture some of that interest credit based off of an external index like the S&P 500, but not have to worry about during a down year being in a position where we lose value. And this comes in handy also. One of the folks at Royal Fund Management, our chief investment officer, always likes to say the best way to make money in the market, or the way you make money in the market long term, is to be a nice person. When everybody else wants to sell you what they have, right? The market's falling apart, everybody's panicking, they're selling. You're in a position to say, well, I'll buy a little of that. And when the market is doing really well and everybody wants to buy what you have, you say, okay, I'll be a nice person. I'll sell you a little of what I have right now. So right now the market's doing really well. Some folks might want to be taking some of those dollars out of the market and putting it into a place where they can't lose it. Loss avoidance strategy might be a good fit for that. That gives them the potential then, when the market does inevitably turn downwards, and it will at some point, they have dry powder to go and go to shopping spree, or when everybody else wants to sell. So it gives you choice and flexibility using a loss avoidance strategy. So that's one way, is to avoid losses, right? And there are strategies to minimize losses,
strategies in place,
even eliminate losses. But the trade-off is I don't get all of the upside.
Don't get all the upside
during a positive.
But you made a good point. You said weather the storm. So a lot of people, if they have all their dollars in the market, in a market-based investment, it's hard to weather the storm.
Yeah.
A lot of people think they can weather the storm until we get a March where we hit 38% losses, and suddenly they're not as in tune with those losses as they thought they were when the markets were doing well.
Absolutely. I mean, can you imagine being somebody who retired in 2000?
Yeah.
Right before the tech bubble burst.
Yep.
And from 2000 to 2007, I think it was July of 2007, the market was effectively break even at that point. So if you had to sell out of investments during that period of time, you were likely selling at a loss. So you would have to make the choice of reducing your lifestyle or selling investments at a loss, or while the market was down. But if you have a loss avoidance strategy in place, you can go there to pull those resources to maintain your lifestyle, as opposed to having to make those tough choices. So number one, avoid losses. That's one way to increase your return without taking on additional market risk. Just don't lose money.
Right.
Number two is minimizing taxes. Right. That's another way that we can try to increase our overall return. Now, that's maybe easier said than done, but actually it's minimizing I said taxes, but I meant minimizing fees and expenses. So if you're going to be investing in the market, right, you're going to pay somebody to do that, right?
You are correct.
Okay.
Whether it's 401ks, there's an admin fee, there's charges involved. Whether it's a broker doing a commission-based trading, they're going to pay a commission fee. If it's someone like yourself, which is an investment advisor, looking out for the best interest of the client, you're required by law to do that. But we charge a fee for investment advice, right?
Absolutely.
So you're going to pay somebody for that advice. What we usually ask, and we always ask, is you're going to pay somebody. What are you getting in return?
Yeah. So know what you're paying and know what you're getting in return. If the value of what you're getting in return is greater than what you're paying, then maybe you're well off. But if you find out, if you really determine what you're paying, And then you come to find out that you're really not getting a lot of value for that, besides maybe 4 quarterly statements a year.
Right.
Then you start asking yourself, well, what am I paying for, right?
Yeah. So what are you paying in return? Many of us know what we're paying for our entertainment streaming.
Like Netflix.
Netflix just went up, by the way, $13.99. I just got that email last night. But anyway, we know we're paying for that, but rarely do they know what they're paying in advisor fees, what they're paying in their commission fees, what they're paying on their variable annuity fees, which have a list of fees inside of those. They rarely know, and we seldom don't get that shocked look. It's more of the time of, I did not know that.
Yeah.
When we show them the fees that they're paying.
Yeah, and we don't want to ride fees too hard, because as an investment advisor, I do charge a fee for the investment advice we provide to our clients. We strive to provide a lot of value for that, not only the investment component, but also the retirement planning aspect of that, and managing that ongoing, having the annual reviews to maintain the plans and make sure we're still on track constantly. However, people are often shocked when we add up all the investment fees on their 401ks, if they own variable annuities, the mortality expense charge, administrative fees, sub-account charges, riders that have been added. If they have a portfolio that maybe an advisor is already managing for them, but they're paying the advisor fee, and then in addition to that, the advisor has them in mutual funds that have net expense ratios, and pretty soon they find out they're paying, in some cases, tens of thousands of dollars in fees. They had no idea how much they were actually paying. And again, if you know you're paying tens of thousands of dollars in fees and you think you're getting value for it because you're getting something beyond 4 quarterly statements a year, you're getting advice on how to mitigate taxes, you're getting advice on how to structure your resources so you can enjoy it, your family can enjoy it, and less goes to the government, and you're able to maintain your lifestyle throughout retirement, that's fine. But if you go, I'm not getting any of that and I'm paying what, then that sticker shock sometimes is kind of tough for folks to swallow. So we try to shine a spotlight on that through our discovery process, really helping folks get their arms around what do they own, what are they paying for what they own, and more importantly, what are they getting in return for what they're paying, and then they can make a determination whether it's worth it. But if you can minimize those fees and expenses, have more of your dollars working for you, less of it eroding, going to fees that are unnecessarily going to fees. That's one way to potentially increase your return without taking additional market risk.
Exactly. It has an impact on the plan.
Yep.
So the last one, Mark, is taxes. And if you want to tell us maybe how we can mitigate some of these taxes.
Yeah, I think as Ben Franklin said, nothing's certain in life except for death and taxes. Right. You're going to pay taxes, but it's a matter of knowing the rules or working with somebody who knows the rules so you can pay no less than what you're required to by law when it comes to paying taxes. And taxes in retirement are there's just so many complexities to that. And first of all, we're not tax advisors. We work with a CPA. If you don't have one, we can guide you towards Chad Harrison, CPA, who we work with. If you have a CPA you're working with, we would work with those folks. But it's important to have a coordinated effort between the financial advisor and the CPA. And we like to work with folks who are tax planners, not tax historians. Tax planners, if you imagine you're in a car, tax planners are looking out the windshield, looking down the road. Tax historians are focused in the rearview mirror where you were last year. So we like to work with tax planners who are thinking 5-10 years down the road. What are our actions today going to do to impact us on our taxes in retirement? But the different taxes that you're going to run into in retirement are taxes on your pre-tax accounts like IRAs, 401ks, other IOUs to the IRS. Maybe you own some after-tax accounts, which are accounts at banks where you're earning an interest rate that's taxed as regular income, or maybe a brokerage account that's an after-tax brokerage account where you own stocks, bonds, mutual funds. Those are going to be taxed at capital gains rates or qualified dividends rates. And then you may have never taxed accounts, and we spend a lot of time guiding our clients on kind of filling up that never taxed account. That'd be your Roth IRA, for example, and doing strategic conversions. If you can set yourself up to be able to have a balance between all three of those, pre-tax account, after-tax account, and your never taxed account, and then be able to blend your income out of those three to try to keep yourself in a lower tax bracket throughout retirement. What I see too often are folks are terribly efficient from a tax perspective. Like they're really aggressive on being efficient from tax perspective, early on in retirement, they spend all of their Roth money, they spend all of their after-tax money, and they keep deferring their taxes on their pre-tax accounts as long as they can. And then they're on Social Security, they're on Medicare, and all of a sudden they start kicking out all of this pre-tax income in their 70s. And their tax rates go much, much higher than they expected. It pushes them into a higher tax bracket. That can affect the provisional income, which affects taxes on Social Security. If their taxable income becomes so high to the point where they're impacted by IRMA, which we covered last time, they can have a surcharge in their Medicare. It can impact the widow or widower of a couple when that first person passes, and now all of a sudden the survivor of a couple is suddenly single and filing as single tax rates as opposed to married filing jointly. All of these things can really kind of balloon to a big problem later on in retirement. So we try to get ahead of that by taking steps now to try to mitigate taxes in the future. And sometimes that means maybe distributing some of those pre-tax dollars now and trying to create what we call a tax equilibrium. If you imagine one of those old-fashioned scales, right? And if you put too much weight on one side, the other side goes up. Well, if you're too efficient in early in retirement, you can end up being really inefficient in later in retirement and cause all kinds of extra taxes and charges on your entitlement accounts, like we mentioned, Social Security, Medicare. So if you can try to create some tax equilibrium, maybe spend some of that pre-tax money early on strategically, filling up some of those tax brackets. Right now with the Tax Cuts and Jobs Act, it's a really good opportunity to be distributing some of that pre-tax money. That might be one way that you can increase your overall return. So, I mean, if you can manage to gain a little ground in each one of those areas, avoid some of the losses, mitigate fees and expenses, and try to manage taxes, not only early in retirement, but later in retirement as well, you can actually increase the life of your portfolio. You can increase how long your resources will last. You can increase that return on your money if you can manage to do those things without subjecting more of your hard-earned dollars to additional market risk. And so it is possible to do this. If you'd like to download a copy of the white paper that we put together, it's called 3 Ways to Increase Return Without Market Risk, and it goes through in greater detail the things that we discussed today. You can visit mypt5.com. That's mypt5.com. Right on that front page there, you can scroll down and put your name, email address, I think is all it asks for. And you can instantly download that white paper. And next week, our topic is going to be a common blunder that is made by many newly retirees. So a common mistake that we see over and over again in our industry that retirees make when they first transition from their working years to the post-working years. We're going to cover that and tell you how you can possibly avoid making the same errors. So until then, Troy?
Every dollar has a purpose.
Every dollar has a timeline. And we want you to retire with purpose and on time. Thanks for joining us.
See you guys.
You've been listening to the 15-Minute Financial Feast podcast. Remember, every dollar has a purpose and every dollar has a timeline. If you have questions about today's topic, schedule a call with a team member. Visit www.mypt5.com. Until next time, be sure you're taking steps to retire with purpose on time. Mark Triplett is an investment advisor representative of and advisory services offered through Royal Fund Management, LLC, an SEC-registered investment advisor. Nothing contained in this program should be considered an offer to buy or sell securities. Different investments have different risks associated with them, and not all investments are appropriate for all investors.